let me introduce these guys because you have an all-star panel here who's been studying currencies for decades. Studying Grant Williams, Senior Advisor, Vulpes Investment Management, 30-year market veteran, writes a popular newsletter called Things That Make You Go, one of the most widely read financial publications. You have Mike Maloney, founder and owner of goldsilver.com, author of Guide to Investing in Gold and Silver, the best-selling precious metal books of all time, recently launched wealthcycles.com, a forum to help educate and empower others to benefit from the greatest transfer of wealth. You have Jeffrey Christian, Managing Director and founder of CPM Group, which he founded in 1986 after leaving the Commodities Research Group at Goldman Sachs. CPM is one of the world's foremost authorities in the markets, and for over 20 years, Jeffrey has worked closely with the IMF, the World Bank, United Nations, as well as some of the most prominent mining companies and investment banks. At the end there, we have Frank Trotter, 35 years experience in the banking industry. Founding partner of EverBank.com, chairman of EverBank Global Markets, which provides alternative investing, including up to 21 non-dollar currency clients can invest in to diversify their portfolios. Most important, his company, EverBank, is a sponsor of EverBank Field, Jacksonville Jaguars, who won 3 out of the last 4 games. It's exciting news for you. You don't really hear that a lot. But on a serious note, I want to start with Grant. You say we're in a situation unlike any time in the history of the markets, a race for countries to devalue their currencies in an effort to strengthen their exports, inflate markets, inflate their debt away. And you talk passionately about this, worried that the final outcome of these monetary decisions will end badly. Why don't you explain that a little bit?
Well, how long we got? How long's the panel? I mean, look, yes, I don't think there's any question that we are living in unprecedented times. And, as the debt has built up over the last 30-odd years, we've now reached the tipping point, as you always do in these situations where it's just unserviceable now. And in order to avoid the painful bankruptcy that would occur, there are several options available, and the easiest one is inflation. That's why you're seeing such a desperate attempt to create inflation. They're failing rather miserably at the moment. And so the natural pressure valve in such a situation is the currency. And so the Japanese have been doing it aggressively with limited success until they really went all in a couple of years ago, and now they're having some success. The Europeans are desperately trying to do it now. But what's interesting is when you look at the yen, and everyone talks about the yen as a sure thing to go to 200, that went from 75 to 110, 115 reasonably smoothly. But what people don't look at, because they generally think of the yen in terms of the dollar and perhaps the euro, when you look across Asia, I live in Singapore, and when you look across Asia, the strains that the weakening yen is putting on the cross currencies in places like Korea, places like Taiwan. And we finally saw the Chinese make a move when they devalued recently. It caused a lot of surprise when it happened, and they've kind of walked it back a little bit. But generally, all these countries need a weak currency, and obviously they can't all have a weak currency except potentially against gold. So yeah, look, I think we are well and truly in a currency war. I mean, the first time it was articulated was by the head of the central bank in Brazil in 2010, and we've come a long, long way since there. The only surprising thing to me at the moment is that people don't see this strength in the dollar as what it is, which is as a fundamental change in the currency regime in the world. I think the dollar's going to go a lot stronger. I think it'll go a lot stronger and then come crashing down again. But I think you need to be ready for a strong dollar environment for the next 6 to 12 months. And that for commodity investors is going to be a painful time.
Let's go to Mike. From what I was reading about all of it seems like you're the most bearish on stage, where you're worried, been quoted as saying fiat currencies always fail. Economic manipulation will cause a crash worse than the 1929 Great Depression. Big promoter of gold is going to go much higher. What are your opinions on currency wars, and why are you so fearful?
Well, I actually didn't say all those words, but I agree with you. And I agree with Grant. But the one currency that they can't devalue is gold and silver. So you've got these competitive devaluations against each other to try and boost their exports. That's the reason they're all devaluing their currencies, but they can't print gold. What was the question again? I'm sorry.
Just currency wars, what are you afraid of? Just to get, it seems like you're more fearful of it, where it could really cause many problems for a lot of people.
I think we've seen the top in the stock markets, and as this rolls over, as the economies get worse, the currency wars just have to heat up because everybody's already doing it, and the one problem with currency wars is no country really can allow another country to win, and so it's a race to the bottom, and the only winner is gold and silver, and I do think it's going to happen. I think for the short term, though, the crisis will probably start overseas, and that the U.S. dollar and U.S. Treasury bonds will be the short-term beneficiary. But ultimately, there will be a violent, Grant just said it, and he said it really well.
Well, Jeff, let's go on the opposite side here, because Jeff, you said that basically when we were talking, you don't think there's currency wars going on, do you? I mean, you have a little bit of a different opinion.
Yeah, I'm not sure what a currency war is, and I'm not sure that we're seeing one. And I would take exception to a lot of the things that Grant and Mike said, with all due respect. For example, gold can't be devalued, but it's gone from 1,900 to 1,000 or 1,100. So that looks like a devaluation to me. And I think that we're not necessarily in unprecedented times. I mean, and one of the questions I had is, as you talk about this stuff, are you talking about the U.S. economy or are you talking about the global economy? Obviously, the U.S. economy is in much better shape than any other economy in the world, with the possible exception of China, but definitely much more powerful and healthier than Europe and Japan and other industrialized economies. So I'm not quite sure, but if you go back to 1947, the ratio of government debt to U.S. GDP today is about 14% lower than it was in 1947. And I suspect if you go back to 1865 and 1907 and 1880 and 1894, you probably see that these aren't really unprecedented times. We've probably been here over and over again. And one of the things I find most frustrating is, as you look at servicing this debt, we could service it with relatively easily implemented government policies. We just don't have the government will to implement the policies that need to be done. We could actually be turning a government surplus, as we did in the 1990s for 4 years, with very easy policy things. It's just not being done.
And I want to get Frank involved here, someone who speaks on currencies. And before we get into it, guys, I see it heating up. Frank, someone who sees something in real time at your bank where you offer, you can invest in different currencies. Is this something, currency wars, countries devaluing their currency, is this something that keeps you up at night? Is this a risk? You could tell the audience it's something that's really a concern here, or which side are you on?
Well, I think it's more of an observation. The currency wars are being fought miserably right now. It's like the World War I trench warfare. We got to the trenches and everybody set up their lines and nobody's going anywhere. For the last 6 to 8 months, really, there really hadn't been a lot of movement. The euro's been between 106 and 112. Most of the other currencies, Australia's drifted off a little bit, come back up a little bit. Canada's drifted off, come back up. And so people are fighting this war, if there is one, rather miserably. And I think you forget, too, that somebody like Europe really benefits from devaluing their currency. Exports increase, things become cheaper, people come into the country. But the U.S. actually has a trade deficit. We're all familiar with that. So as we devalue our currency, it actually becomes more expensive. We buy more things from abroad. They become more expensive with a devalued currency, and we don't get the percentage pickup from a manufacturing boost if that, in fact, ultimately occurs. Now you get different sectors of the economy that benefit, and I think we do need some of those manufacturing benefits. So just to keep us up at night, it absolutely keeps us thinking. How about that? Because we're really more commentators on the market. We provide an opportunity for people to choose what they want to invest in. And to the extent that commodity currencies, Australia, Canada, Norway, some of the other major currencies out there are down in the dumps for all the reasons we've talked about at this conference today and tomorrow. There's some other opportunities for people to look at. Does Europe continue to drift off for a bit, but then turn around? The U.S. and Europe in particular are more fiat-oriented. that don't relate to a commodity production, that don't relate to, let's say, a Chinese manufacturing growth over 10% since 1995. So, yeah, it keeps us up at night, but we really look at it as there's always an opportunity. You know, there's something moving up. You know, right now, I'm pretty intrigued with Argentina. You know, the new election over the weekend. This new government has said they may actually float the peso. It'd be very interesting to see where that goes.
So let's get to Grant. I like the smirk when Jeff was talking.
No,
So we'll get things heated up.
Yeah,
Yeah.
look, the thing that struck me was the comment about the U.S. being a healthy economy.
Relative to you.
Well, yeah, but see, and this is the problem I think we have at the moment. Everything's relative now. If you went back 20 years, Asia was a standout buy. You knew that those economies were going to grow for the next 2 decades. And here we are today talking about the US being relatively strong compared to Europe, which is a complete mess, Japan, which can't get out of its own way, and this government is going to take that country down to the toilets, China, which is in all sorts of problems. Guys that I know that live and work in China and do business up there say it's way worse than the headline figures would be thinking. And so here we are in the US, where we have a relatively healthy economy that can't raise rates from 0 for 7 years. And now we're talking about a 25 basis point rise. And you look at the dislocations that set off when they thought it would happen in August. That's not a healthy economy. That's not the sign of a healthy economy. You have a Federal Reserve who need to raise rates. They shouldn't be raising rates. They need to. And why? Buried in the Fed minutes, which I was really surprised I didn't see anyone talking about, but they actually said that they need to raise rates because if they didn't do it, it would damage their credibility. Now, if you have a central bank in the minutes, and it's in the minutes, I'll find the quote tomorrow and put it in my presentation, but if you have a central bank that's worried about their credibility in the markets, it tells you they've become way too big a factor in the market. So look, I don't think the US economy is healthy. I think it is healthier, but it's not healthy, and I don't want to invest in a healthier economy. I want to invest in a healthy economy. And I just can't see anywhere in the world that I'm really comfortable putting capital to work apart from private businesses that hopefully have access to funding and have decent cash flow. I think equity markets are overvalued. I think government bond markets are ridiculously overvalued. I think gold and silver are the answer. I just don't know when, and I'm baffled as to why that hasn't happened yet. But look, there have been, I've got it in my presentation tomorrow, there's been 30 reasons why gold should have gone up in the last 3 years, and it's done nothing but go down. But unfortunately, that's just where we are in the cycle. Sometimes these things happen. You don't know why they're going to happen. You don't know when things are going to turn around. But ultimately, this is a problem of mathematics. There's too much debt. There's not enough growth. Something has to give. And unfortunately, it's going to be the debt one way or another.
I guess, Mike, you brought up an interesting point, and we just said too, as well, Grant, is time. You said short term, it's going to we hear that all the time, and to be fair, we've heard that for the last 4 years, right? I've heard it so many times, the dollar's going to crash, it's going to be horrible, gold's going to go higher. When you say short term, it seems like, is it almost like a hedge? Is it saying, I could be wrong, I don't know when this is going to happen, and nobody knows when it's going to happen? Because you can go into more detail of, and someone who studies economic cycles, when? I'm not talking about the date, but actually in terms of years, because it seems like when I hear this argument the most, a lot of people were selling the dollar over the last 4 years, we're seeing the dollar go higher. When do you think things are going to get much worse? Is it simply with the Fed raising rates? When does the you-know-what hit the fan?
So you want some predictions.
I think they
Whenever
want predictions
you can either predict that something's going to hit a certain price, or you can predict when it's going to happen. But when you predict that it's going to do this on that date, you're always wrong. So
Don't take the bait, Mike.
So-
Don't take the bait.
what?
Don't take the bait.
Yeah, it's true. 'Cause
Well,
I get that question a lot too. Yeah, you're right. But
And by the way, I've been hearing that the dollar's going to crash pretty much forever. I mean, people have said that since it became a fiat currency. But there are cycles to these things. And yes, this is it's a little bit larger and drawn out. If you look at a picture of the markets or anything else, it sort of looks like this giant picture of the 20s or something, where it's very stretched out. I think that I have said many times that there will be a currency crisis and there's going to be another major crash before the end of this decade. And I believe that, that there'll probably still be a dollar, but it'll be a different dollar, just like it was a different dollar after World War I than before World War I. It was a different dollar after Bretton Woods, after World War II, than it was before. And it was a different dollar after Nixon took us off of gold in '71 than it was before. These are entirely different monetary systems. The whole structure of the monetary system has changed each time to where, at first countries were all fully backed by gold, with the Bank of England being the clearinghouse. And then you had a mixture of British consols and U.S. bonds and gold being the backing of currencies. And the clearinghouse in the intra-war gold standard was both the New York Fed and the Bank of England. And then after Bretton Woods, every country on the planet was backing its currency with U.S. dollars or U.S. treasuries. And the dollar was the currency that was backed by gold, and it was redeemable at the New York Fed. And then no gold, just dollars. And so it's all backed by the promise to tax us in the future. It's backed by future debt. We sell when the Fed buys a treasury bond, it creates dollars, and so we have to work in the future to pay off that bond. So these are very, very different systems. Every 30 to 40 years, there's a new world monetary system, and we're now 44 years into this monetary system. It's overdue, basically, for a change. And history will just repeat, and there will be some emergency meeting to hash out a new world monetary system and I believe a lot of what Jim Rickards says also, that there's going to be some real chaos during this period. And I think it's going to happen before the end of this decade. Mm-hmm. And so I'm putting a time on it. It feels like the markets have topped, and if you look at the last couple of crashes, it took 1.5 years or 2 years for them to roll over and bottom. So, we might see things going flat in 2016, and then 2017 and 18 a real plunge. Who knows? I don't know. But what I do know is that every 2 to 9 years there has been a recession in this country, and that there is no exception to that. There's never been an expansion longer than 9 years. We're 7 years into this expansion. We're due for a recession. The Fed is out of bullets with all of the currency creation they did and the zero interest rates. There is nothing they can do this time except create massive quantities of currency.
Just for the point of clarity, when you say the end of the decade, do you mean the end of 2019 or the end of 2020? I just want to be clear on that.
Thank you very much. I hadn't thought of that. You just gave me an extra year. So that's an extra 20% that I have to be right. 20% more time.
And people love those predictions. I get it all the time. I appreciate that, again.
Okay.
Jeff, you want to respond to that? Because you mentioned the word surplus, which I looked at the faces of some of the people in the audience. Why don't you respond to some of the things that they're saying, since it seems like you're on the opposite side there?
Well, there's a whole lot of stuff to talk about here. And if you want to talk about surplus, first off, understand we've gone from $1.7 trillion deficit to about a $400 trillion deficit. If we stopped our imperialist wars and went back to a pre-Bushian defense posture, and if we went back to the 39.4% marginal tax rate that I think George I and Clinton had, we would have a surplus. If you did a couple other things like find a way to finance the unfunded Medicare payments or pharmaceuticals, which is now about $400 billion a year that Bush passed, you could actually be turning a surplus on the order of $600 to $800 billion a year. And you could start paying down our debt. As we paid down almost $1 trillion in 4 years from, say, 1998 to 2001. And I think people tend to forget that. I think we were talking about currency wars, and one of the problems I have, and these guys hopefully can talk to me about it or explain to me, the fact that the dollar's strong and the euro and the yen are weak is, to me, an outcome of relative economic strength. And yes, it's relative, because actually everything is always relative. The question I guess I have about currency wars, are you talking about the fact that because our economy is stronger and healthier than theirs, their currencies are falling? Or a currency war, the term implies to me that you have governments saying, I must lower my currency rate. And I think that there's a gigantic gap between governments saying lower exchange rates would be good for our economy, and governments saying, let us manage our fiscal and monetary policy in such a way as to drive the rates down. And I think that that's one of the big keys. But the other thing is this, and the single most important thing you can say about currency exchange rates is that the only currency exchange rate that has not collapsed is the current one. You have all these people who will tell you, there's never been a currency system that wasn't backed by gold or silver that collapsed. And that's true. But it's also true that every other currency exchange rate except for the current one has collapsed, and most of them were backed by gold and silver. And people bastardize my good friend George Bernard Shaw's comments. He once said, if you had to choose between gold and politicians, I would trust gold, not politicians. But the fact is, politicians have always, at least since Roman times, known how to bastardize gold. So the key takeaway is understand that the current international currency regime will collapse at some point. And central banks around the world have unilaterally and collectively talked about this since the 1980s at least. It's clear that the time of a de facto dollar reserve system will end. And the problem is there's nothing on the immediate horizon. And if you wonder why the Central Bank of China has $3.9 trillion in reserves, and why the Thais and the Philippines and the Japanese and the South Koreans and the Singaporeans and the Hong Kong Monetary Authority all have these massive reserves, most of which are denominated in dollars, is because they want war chests against the volatility that they expect, not over a few years, but over decades, if we're lucky. I wasn't raised a Calvinist, so this whole idea that things can only be resolved by fire, by cataclysmic collapse, is not part of my psyche. And when you talk to central bankers, they say, yes, there are risks about that, but there are, in fact, a lot of tools available for central banks to try to keep us out of global or national depressions and give us the time we need to try to resolve this stuff over decades. And again, remember, the first time I started talking to the People's Bank of China about making the yuan exchange currency convertible was 1981. And I got really excited, and they said, listen, this isn't going to happen in 10 or 20 years. This is a multi-decade process. And that's how central bankers think about it. They say, we have to try to keep this all together. I could go on, but I think that's probably enough for now.
I saw you, Frank. I had a question for you, but it looks like you want to jump in here.
I think one of the things you can look at, there's different central bankers just like there's different politicians. In China, I think they do have a extended viewpoint. They're well down the road. They, 50 years from now is kind of their general target. I think the U.S. Federal Reserve has about a 2.5-month horizon. It's political. Grant mentioned the credibility issue is the primary reason to raise rates. And in fact, I'll be talking with one of your colleagues about the fact that I don't think that they should raise rates. I think 70% of the people in the market say they will. They're probably going to. I don't think they should, because I think you are going to start falling back. And I think there's a parallel issue with currency devaluation. I think some countries have currencies that devaluate and exports improve. Japan and China are two countries who explicitly attempt to have their currencies devaluate. China more recently, Japan over the last 10 years or so, somewhat successfully. And if you probably noticed in the news over the last 3 or 4 weeks, every time the euro pops up a penny from 106 to 107 to 108, one of the central bank members there comes in with a comment that says we will continue to beat this down by more and more their version of ZIRP. It's a little more complicated in their world. And so I think, putting all those things together, do I think we're going to have an imminent collapse of the currency regimen by 2020? I think the probabilities are relatively low. It's certainly possible. I've been in the dark side for a long time as well. Debt scares the heck out of us. But at the same time, I think right now you're seeing the strong dollar largely as a flight to we kind of laugh when we say this, don't we? A flight to quality. People are nervous about the world. There's terrorist attacks in Europe. There's disorder in a lot of the other parts of the world. The Middle East is rather dangerous, as all the commentators here will say. And I think investment managers taking care of private funds, taking care of institutional funds say, I really want to get up in the morning and have that be there when I get up to look at the portfolio in the morning. So I think I'm going to do something in dollars. And it doesn't necessarily make any sense. So the dollar likely will stay strong. Maybe it's a year, maybe it's 2 years. Raising rates at the Fed, continued flight to quality. But I think in the long run, we do have a downward trend that'll continue from our, call it 1912 or 1971. It doesn't really matter where you started. The dollar's had a downward trend.
All right, we have 5 minutes left, and we're talking about a global macro theme here, but for people in the audience, and again, we've seen a variety of so many different forecasts, is it simply buying gold or silver? Because I hear the word protect all the time, and when I hear the word protect, I think of putting my money under a mattress, or that I'm not going to lose the money. And if you're buying gold or silver over the past 2 years, probably haven't done too well. So I guess, how could individuals who are worried about things like this, and I guess we can go with Grant, what advice would you give them? Is it simply buying gold or silver? But maybe each one down the line can provide different advice of how they could protect themselves or how they could benefit from this, because I think that's what's really important here.
There's no simple answer to that question, unfortunately. Everyone has different requirements. Everyone has a different idea of what protection is and what safety is, unfortunately. But something like gold, with cash at zero and negative in many places, there's no opportunity cost in holding gold. It's a very emotional asset, and people tend to get into it for the wrong reasons and spend way too much time obsessing over it. If you'd put 5% of your portfolio in gold the last 4 years when it's performed horribly, the other 95% that you had in stocks and bonds would have done just fine. And so having that insurance policy really wouldn't have cost you anything in the scheme of things, but people obsess over the price. And it's generally the first question I get asked whenever I talk about gold all around the world is, what's the price? Where's the price going? Is it going to 2,000? Is it going to 2,500? And the simple truth is, as Mike said, none of us know. But you look at the math behind it, and you look at the reasons for owning it, and everything tells you that the path will be higher. Look at the increased demand, look at the reduced supply. It's a fairly simple equation, and yet this shiny yellow asset that no one can value by looking at a balance sheet or an income statement, they can only value it emotionally, and so people get very emotional about it. Gold's gone down from $1,900 to where we are today, $1,100. You know what? If you bought that at $1,900, yeah, that sucks. If you bought it at $200 or $300, it doesn't really matter. It's still doing what it said it would do. So I think having an allocation to gold or precious metals makes sense. There will be a time when it doesn't make sense, but right now and for the last 15 years and possibly for the next 10, I think it makes sense. But the size of that allocation varies instinctively with your tolerance for pain at the moment and the amount to which you're worried about things. I call it an unsurance policy. The percentage of you are unsure about the outcome of this thing is the percentage you should have in gold.
Same question, Mike? Go ahead.
Well, actually, I'd like to make a couple of comments. First of all, there was no surplus during the Clinton years. That was a smoke and mirrors accounting. If there was a surplus, the national debt would go down. The national debt went up every year. You need to check that.
You're including all the off-balance options.
I'm including how much we owe, how much we borrowed, how many treasury bonds were sold. The national debt went up in each of those years, and if we had more income than our expenditures, it would have gone down, and we didn't. It was a smoke and mirrors accounting. Second, gold has never failed. Yes, there are currency systems that have failed because they were gold standards, or they were cheating gold somehow, or they debased gold somehow, but gold has never failed. And third, we suffer from, we're stuck in this low level of prosperity because all of these quants that run the system will not get out of the way of the free market. They feel that they've got to steer this thing and try and control it. And all that does is diminish our prosperity. And there's something about prosperity. It is a compounding thing. The transactions that we make tomorrow depend on how many transactions we make today. And so every time they do damage to the system, it's permanent, and it's irrevocable. It cannot be repaired. And these idiots that think they know more than the free market, that try and steer this thing, are causing us tremendous pain, and you don't know it. I mean, we don't have a comparison. We can't. But the free market is what has brought us all prosperity throughout the years. There is no other source.
Let's go with Jeff. Go ahead.
Sorry.
Hold on. Let me just give you one small comment on time frames. when you look at gold over the last couple of years, of course, it's gone down. We all know that. We're probably all holders. One of the guys on the desk, and when you select a time frame for any investment, you get to cheat, you get to have a great time. But since 2000, gold returns versus the S&P compounded return with dividends. Gold's about twice the return of the S&P. S&P's in the 3-point-X range. Gold's in the 7-8 range. So again, it's all about perspective, all about long term. It's all about, frankly, diversification. We all know that. We all have to live with it. And as Grant said, it's what's the proportion that you're going to put into your gold or silver account, and move forward with it for risk and for other things.
And we'll finish off with Jeff here. We got about a minute left.
I want to return to your question, which was, is it just gold? But first, let me say, in terms of an earlier question, my timing, 2017, 18, 19, I think we get into a period of worse financial and economic conditions, and gold prices, which I think move slowly higher between now and then, start accelerating to much higher levels. And depending on which scenario you run, it would not be at all surprising to me to see gold and the dollar rise sharply 2018, 19, 20. Now, to your other question, it's not just gold. And last August, we were approached by a wealth management company in London. They said, we have some very wealthy investors in the Gulf region, the Persian Gulf, and in Singapore, and they still want to be invested in gold, but they don't like the gold products that have sold them. And it was very interesting because they said, this is what we want. And what they said they want is what all of us should want. So we want to have physical gold. We want to have access to it. We don't want to have to pay a lot of money. Like if you have an ETF and you want to liquidate the ETF and take physical gold, the fees on that transaction are way too high. So we want to be able to get it and convert a note or a managed account into physical gold in our possession very easily and cheaply. We want some downside protection because let's be honest, there are a lot of people I've been listening to, the investors in the Gulf, who have been telling me that gold's going to 2,000 or 3,000 and the dollar's going to collapse, and they've been wrong, and they've been wrong on my dime. So I want some hedging. I want physical gold. I want puts. And they had very fascinating list of risks. Risks that we all think about, but risks that we didn't think about, that people in the Gulf region or Singapore think about, like risks against the bank failing. Okay, I have gold on an allocated account in a bank. That bank fails. I have gold on an allocated account. I should be able to take it out. But the bankruptcy courts, and this has happened, say, yes, you'll be able to take it out when we figure out exactly what that bank's situation is, or a brokerage house. And there are all kinds of risks that they wanted protection from. And I think, to answer your question, you want physical gold. You want to be able to take delivery of it. You want to be able to take delivery of it cheaply. You want to hedge it with puts. And you want to watch out for your risks because there's 100% certainty that there will be future economic and financial storms. The question is when and how severe.
That's great stuff. We'll leave it there. Great job, guys. I will say that Marin just whispered in my ear that he has a very special announcement, a big announcement. So please give these guys a round of applause first.